Hey, Michael, how you doing?
Hey, Shani.
What's going on with you, dude?
Uh, nothing, nothing new.
Do you have any classes that are in on campus too, or no?
No. All my classes are either online or over Zoom.
Yeah, it's what I keep trying to figure out what science classes had, you know, what class was it where that student got had COVID or something?
I'm
Do you-
willing to bet it was one of like the phys labs.
That's what I was thinking because did you notice they were like really cleaning the E building for like a long time?
Oh,
They're
Eva.
like, yeah, they were like they had like the machine that like washes the floor, and they were like doing all this like hardcore
Oh,
stuff. And
I don't think there's any classes there. I don't on
oh,
that
really? So even the labs are done in the D building or in the E building, you think, or the A building?
A building because I think those ones are more like the health sciences one,
Oh,
and they have to be. I would think they have to be pretty close together.
you would think so. I don't know. It seems pretty crazy. I don't know why anyone would even want to risk having class um, in person. Seems crazy to me. Hello, Karen. Hello, gentlemen. Jerry and Elijah. How are you all
Hi.
doing?
Oh my gosh, I like your background.
Oh, thanks. This is the one that Zoom gives you. I had a meeting at a conference on the mainland, and um, some people, how like some of those like Zoom ones have those like fake books in the background that make it look like they're in the middle of like a library. Well, those people actually have all those books. Like maybe they took a picture of their house to make the Zoom background. Yeah.
Oh my gosh.
Yeah.
The chickens are going off, so I'm gonna just mute myself.
No, you're fine. It could have easily have been at my house where they were going off. What about you, Elijah? How's everything going for you, dude?
I'm surprised I survived the last
Oh, look at all
the
the
three
books.
weeks.
Look at that. See, look at all those books.
I have a lot of
Um,
knowledge.
so are you doing, I was going to ask you, are you doing the classes then at Manoa this semester or no? Or what's happening?
I was gonna do them next semester because I don't know, like I think I'm in, but I'm also maybe not in. I'm very confused with the current situation.
For the classes next semester?
Yeah, so I'm gonna double check on that as well.
Yeah, I don't think they haven't started registering yet either. So, because I'm at Manoa for
Well,
a few
even
classes.
I think I
Hmm?
applied for this semester and I sent all the things in, and I got a yay, you made it, and then like nothing. So I was like, wait, did I make it? Or so that's kind of why
You
this
mean
semester fell through.
for the fall? You
Y-
didn't the reason why you
Yeah,
didn't take the classes was because you didn't know, or
yeah, I wasn't sure if I was in or not, so it was a very um, confusing thing. I think they might have registered me as a freshman at the beginning, and I think now they fixed it. I gotta call a couple people.
okay. Well, the important thing would be what do you know what class you're going to take or no at this
The
point?
425, right? Because I already took econometrics last semester or last fall.
Correct. Yeah. Yeah.
Yeah.
That's good. That's good. Okay. Because this would also be around the time when you should start applying for the program itself.
Right.
Do you know when the deadline is? I don't.
Nope. Again, the last 3 weeks, I said yes to way too many things at work, and then yes to well, then also I found out my math class is evil.
Dude, the Noe Center. What are you guys doing at the Noe Center? Is this stuff even actually going on?
That's the thing. I thought we shouldn't. Turns out we do.
Like what?
So the proctoring picked up. A lot of professors were like, "Could you proctor our exams?" About a week before they requested. So we had to train that. Then the
What does that mean, though? How do you proctor an online exam?
Yep. So we would to kind of facilitate what we would normally do, we would actually have people log in during the exam and then watch them throughout the process of the exam.
Dude, that sounds really creepy.
It is. But that's how we justify our service.
Like,
Yeah. No, we do our best. What we do is we mute ourselves, turn off our webcam, and that's it. But we
how
are
are you
there
gonna
staring at you.
possibly? How are you gonna possibly? Okay, so okay, I know we haven't like started yet class, although we kind of have started class. So, as many of you may know, I'm teaching also at Manoa, right? Big class. It's a big like intro class, and it has like 70 or 80 people in it, right? So I have an online exam, just like everyone else does, and exactly the same issue that Elijah's talking about, right? Like, how do you control cheating, right? And everyone's like, everyone cheats, and I mean, the Manoa kids, they're pretty crafty about their cheating. Apparently, what they do is they all get together and they get on like Discuss, and they like do the exam together. Just like outside of doing proctoring, there's like almost no way to control for that.
Yeah.
Except my solution. So I told them, you know what, I was pretty honest. I said, I cannot stop you from using Discuss. I'm not going to stop you from using it. If that's how you want to do this exam, more power to you, except what you submit is your own. But they only have an hour to do 30 multiple choice questions and 4 short answer questions.
Ooh.
How are you gonna get that many people in a room together to like agree about stuff?
Yeah.
Which is exactly what's happening, is that when you make the exam well enough, like it's not that it's impossible to cheat, it's just there's not a lot of incentive to cheat. I don't know. So, okay, so you're being a creep and watching people. What else?
Oh, for the
Anything
proctoring or?
Yeah.
We fill out a form every 30 minutes. If we notice you do anything wrong, then we add that to the form. We record
Like
the whole
what?
session.
Like what?
We've only, we've had people like
Okay,
have
here.
multiple
Okay, I'm watching you
devices.
right now. This is
Yep.
for everyone's benefit. I'm watching you right now. Show me a move that would show me that you're cheating.
Well, we'd tell them to set up a secondary camera that watches them from the side.
Jeez, fuck. Like, really? Like,
Yeah. That was one of the trainings, is walking them through setting that up.
Okay, so a student who's taking this class has to conceivably invest in a second camera.
Or their phone. We tell them usually use their phone.
How do they stream that picture?
They log in with their phone and their computer.
So there's
onto Zoom.
You're watching 2 accounts where like how many, like 15 people maybe? Oh, so like 30 accounts almost.
So what we would do is we would split us up into breakout rooms, and we have a proctor for each room. So that's why it's time consuming and a bit expensive, as each one of the tutors would be a proctor for a room.
Jeez.
So we only work with one person per time.
Okay, show us a move of you cheating. Like, if I was the proctor? What would I have to do?
Sorry, that was loud. The first thing that they would normally do is they start ducking their head.
So is that?
And then it means that they're looking at a device that's underneath something or below them. So then you want them to stay like this so you can see body language and whatnot. Once they start doing this, you're like, okay, they're doing something.
People have to. God, you know what? I hear.
Disadvantage. Because you could see the reflection, kind of.
Yeah.
The other thing we look for is if they stop, like they pause the screen sharing, because then we know they opened up another window. So we
Can they have headphones on? Can they be listening to stuff?
No. So that's what we do, is we have them screen share what La Lima, which is what they do the exams on usually. And we make sure that they're sharing screen sounds so that if they get like a message or something, we hear it.
Jeez, you know what? Just I don't know.
Cut your losses at that point,
Cody.
huh?
I don't know what you're thinking here, but like when it's set up like that, I almost want to cheat. Like not that I want to, but I almost want
challenge.
to. Like, yeah, I don't know. Like, see, I can see right now. Russell's cheating right now on a BlackBerry that looks like it's
cheating.
ancient. Dude, a BlackBerry. Wow, jeez. Yeah, that's crazy. I don't even know what to say. Anyway, so so for Manoa, and then I'll actually start class here. So for Manoa, for mine, like all of us professors that are like teaching, like there's a whole bunch of them that are getting really grumpy about all the cheating happening in the undergrad classes, and like all these methods they're taking to stop people from cheating, and it makes me look like I just like let the barn doors open and just let people do what they want. But yet, either it shows I'm a really bad teacher or that my methods are somewhat effective because the class average was still 73%. So like, I don't know, like, not that you can make the exam uncheatable, but
I
don't
say
know, give
let
it
them
some
cheat.
fun. Exactly, isn't that like if that's what they want to do, like,
I mean,
like,
if they're sloppy, then yeah, catch them in the act. But if they're good at it, then I mean, they're paying how many thousands of dollars for the course? I mean, it's not really cheating if you think about it. They're getting cheated, if anything.
well, so in my case, La Lima goes down to the second in terms of how long you spent on an exam. And so I had 4 students that all took the exact same amount of time and got the exact same ones wrong on the multiple choice. I mean,
Coinky dink.
exactly. It's not, but at the same time, I got better things to do than like be like Elijah and like be creeping on people. Like I got better things to do.
I mean, I get paid for each hour I sit there, so.
No, I know, dude. I know. I feel like I should proctor just to throw some more money your way. Okay, so let's see here. Okay, it is actually good to have you all back. I actually missed us not having this. Although I'm kind of sad I didn't actually take into account, I don't know why, but we actually still have election day off next week, Tuesday.
Oh
so we
man,
do not have
we don't have class.
it's apparently it's a university holiday, so no classes at all in any UH class. There's
Isn't
no
that
UH
funny?
club.
Like I pay for classes, and they decide when we have class or not. You know what I mean? Like.
Yeah, no, so I'm actually still going to make a lecture, but you guys, none of you have to watch it on Tuesday. You can watch it whatever day you want.
I'm only saying that because I like this class. Like other
Yeah.
classes, I'd be happy, like I don't have class.
Yeah, no, my math class, I'm glad I'm skipping that one.
Yeah, see,
Yeah,
like,
see,
I'm good.
well, today is actually going to be a fun day because I saw that about half of you have done your Bloomberg stuff. So that's good. The others of you, I know who you are, who haven't done it. Don't worry. Seriously, some of you, as you would know, some of you got like 50% on some of the modules. You still got your certificate, I think. I think it still shows me that you got your certificate.
I got a 36% on the.
I saw that. Yep.
On I think it was
Was
the
it the
economic indicator module.
Oh, indicators. Okay.
Yeah, I got
But you still got the
36%, and they
certificate.
still gave me the certificate.
Exactly. So and there's about half of you who have not done it yet. Just finish it up. Try to focus on finishing it up this week.
When is the deadline?
There's not. About half
Okay.
of you have done it with no deadline. So now I'll start to like push some of you. I'd like most of you to try to finish it up by next week because next week is your official ad drop date. I mean, if you haven't done anything, you at least want to have started some of the modules. Some of you have not started any of the modules, and you don't have to look ashamed. I know who you are. But you should at least start some of the modules. And again, it doesn't matter. There's no shame in getting a 30% or a 40% because some of the questions are pretty confusing. And
one of them was worded wrong. I was doing the currency
Which-
exchange question, and it was like,
okay.
How many like UK or Danish francs can you get with 100 euros? So I converted 100 euros to UK francs. They wanted it the other way. Like how many francs would it take to buy 100 euros? And I'm like, wait, no, I have 100 euros.
I actually think I got that one wrong too. No, I mean, so there's ones like that I got wrong. And then there's other ones where I forgot to subtract from 100. So I said 103 rather than 3 or something like that. Like there's some silly ones that I got wrong too. But it'd be good if most of you tried to finish those up, even if you just start one of them, because obviously by the end of the semester, you all want to finish those up. And that says nothing for the fact I know some of you, at least two of you, have gotten pretty far actually in the CFA curriculum, which is also good. I'll put this out there as my advertisement again. We still need about a member or two for our CFA research analyst team. I've got some good leads. Don't think I don't have some good leads. I have some good leads, but we need at least one person, and I gotta find that person this week. So if you are that person or you know someone that would, let me know. We don't know what the company is yet, so I guess we will find that out soon. Okay. So I got two things I want to do today. I want, here's what we can do. Here's the easiest way to do this. In chat, I want some of you to start putting some of the tickers of some of the things that you were either interested in talking about or were interested to know more about. And then while you're doing that, I want to show you the one chart that interested me this week. And then for today's lecture, I made a very centric presentation on Bloomberg functions because I want to start to now that many of you have gone, at least half of you have gone through the Bloomberg market concept curriculum, and now some of you can I want to push some of you to now start using the terminals more. So I'm going to start to talk about some of the specific functions a little bit more in today's presentation. Okay, so while you all are doing that, so again, in the chat function, either be putting the tickers of something you're interested in or something that you are able to talk about. In the meantime here, I want to show you the chart of the thing that I was interested in. So, as many of you know, I just closed on a house. And what always interests me about talking to other people in these kinds of ways, I'm always interested in talking to other professionals about like what the indicators are of what it is that they're doing. And so I'm sitting there, I'm waiting for a termite inspection, right? It's like 2 hours of this guy looking around for bugs. And I'm talking to the other agent, and she was about my age. She owned, what was it, like 3 properties that she rents out. And she's obviously a real estate agent, so she represents people on the buyer side and the seller side. And what she told me last week was that the biggest problem that she is having individually and that her clients are having is individuals who are not paying their rent, but who have the money to pay the rent, right? So we know that during COVID, individuals can postpone their payments, and that they cannot be evicted for non-payment. And so individuals are not necessarily having lost their jobs, they're just not paying their rent. So what that encouraged me to then do is I wanted to say, okay, well, let's look at how many people does this really apply to? Like, unfortunately, I don't get that option. I don't know what I would do. I mean, I probably would still pay it because leaving money in my bank account is just never a good idea. But I want to show you the chart I was looking at earlier here. Isn't that right here? Look at this chart right here. Everyone can see this? card?
Yeah.
So look at this. This represents individuals who are paying their rent with their credit card. So basically, you wouldn't pay your rent with your credit card unless you had like no money, right? Like no money in your wallet at all, like nothing. Like that's right. And we're not talking about like doing something to get points and just paying it off every month. We're not talking like that. We're talking about I lost my job. I don't have any money, but I'm paying my rent somehow. So I'm going to use my credit card to pay it and then worry about, paying off the credit card later. Look at that spike of what people are doing. So that's the dark blue line. People using their credit card to pay rent it's almost doubled, right? It's getting close to 75% in terms of using their credit cards to pay, their rent, which I think is amazing. But then also, going back up to here, look at that. So who is it that's behind on rent? So the Philadelphia Fed actually did a pretty interesting survey of who's not paying their rent. It's a lot of people. This is by race, but this is saying that 1 in 5, right, African Americans that rent are not making all their rent payments, that almost as many Asians are not paying their rent on time. Fewer Hispanics, fewer whites, right, are not. But overall, outside of whites, it's still a pretty sizable chunk, which then got me to thinking a little bit more about this. So next week's lecture, which is not required, and it's not required because technically we don't have class, but I want to make something, not only because you paid for it and someone should be doing their work, but also because I want to talk a little bit more about economic development. Sorry, I'm just waiting for, here we go. No, I can hear my son coming in. My children are very loud. You can hear them outside. Sorry, it's not in the paper. I'll find it here. But basically, it's a discussion of, again, that a sizable chunk are not paying their rent and they cannot be evicted. When that runs out in January and they can be evicted, then we're going to be looking at a very different situation in terms of things. Hey, Piercy.
And I'm back.
How was school today? You have friends outside that wanted to see you. You did?
It's okay. Come on, here.
Okay, I can't find the report, but I'm going to look for it. I want to just here very quickly look at what some of the companies are that some of you are interested in looking at. Banco. What did that say, Elijah? Eon 2?
So I meant to say round 2, but I fat fingered it.
What does that mean, round 2? Like, I got you. What is that, Jasmine? What is that? Nokia? What is that?
Nicola.
Oh, is that the other electric car maker?
Yep.
Is that what that is? Okay.
It's the truck company.
Yep, and then Cody's favorites, AMD. Yeah.
Oh yeah, I can't wait for the 6000 series card to come out. It'll be interesting.
Oh yeah, that'll be a game changer.
Okay, what about
already? Especially what Nvidia did.
what other ones are anyone? Russell, hi, I've been looking at Rig past 2 weeks.
It's still at 80.
It's like 81 cents. I saw it at one point.
Yeah.
course. Hey, we all hear you. I'm gonna go upstairs.
How do you feel about reviewing an ETF?
Oh, I mean, I guess I don't. What was the second one?
I suggested an ETF, QCLN, like
Oh yeah. No, I know what you,
just a clean energy ETF, because I don't really know.
yeah.
I don't know the sector, but I personally feel that clean energy will see a rise globally.
Oh.
So, and I
You
don't
know,
know what company to look at.
Yeah, that's a tough one. I mean, a safer way to play that would be to go with NextEra, right? Because then you can do the utility company that's known for having the largest investment.
Yeah.
The largest investment in clean energy.
I have one share of them, but that was only because they were the biggest market cap, and that was all I knew about them for like a solar energy producer. So I figured they were a safer bet than others like Sunrun and Phase or something.
Sunrun is a stock too?
Yeah, I think they're called Run.
See, because I'm at the point where I have to now buy solar for this house that I now own soon, and Sunrun was one of them. So, okay, let's see here. Oh, Disney. Yeah, Karen, that was one where Disney really has to undergo this now shift, because for Disney, they've got this problem, right? That a huge chunk of their revenue source is now gone, but a new one has emerged. So they lost a lot of money from the theme parks, but now they gained money from the from the streaming, with Disney Plus. And they missed, I think, slightly on expectations, but they just laid off like 30,000 people. So, and then you got JP Morgan here, I see. QCLN. Okay, this gives me some things. Okay, so can everyone see my screen? Did I make sure I'm still sharing?
Yes.
Yes. Okay. Perfect.
Yeah.
Okay. Okay. I will say this. I'll make a short video, or I'll assign one of my helpers to make a video. But you can use Bloomberg terminals next week to track the election. It's probably actually going to be nicer to track the election results on Bloomberg, and it'll be faster than watching TV. As you know, when Trump got COVID, it was announced almost first on, for those who had me for Thursday class, it was announced first on Bloomberg. Okay. So here's what I wanted to do. I wanted to talk about some more in-depth tools of what we can do with the Bloomberg terminals. And I just want to start simple. So for each of these, I'm just basically saying go. When I say go, that's basically the main function area for Bloomberg. So this first one, CVID. So in Bloomberg, again, mine's going to look different than yours, but don't get all worked up about that. But if I go for the function CVID and go, sorry, it should have, why is it not? Oh, CVID, sorry. I did. Okay, well, maybe it's just using this on the iPad, which I don't usually do here. Okay, let's try it this way. Well, if you're on the traditional terminal, Yours will look better, I'm guessing, than mine. Are you fucking kidding me? Okay, they changed it. It used to be CVID. It's now virus VRUS. Okay, or maybe it's just that on my. It might be CVID on a regular terminal. So if you're on your computer, it might be CVID. But apparently here on my iPad, it's showing up as VRUS. Now, what that does for us, right, is on the Bloomberg terminal, it gives us a really good way of looking at what's the reality of the numbers that we're looking at. But again, just like everything within the terminal, we can then customize things. So here on the iPad, I can't really, don't think I can, yeah, I can't really do things that differently, I don't think. I mean, it's interesting if you just want to look at a whole bunch of numbers. But what's really cool here is if you do it on your terminal, which you're all at, I just took this screenshot from mine. You can see here that I can pick specific countries and I can plot it out, pick the time period that I want to do it over, and draw my comparisons. I can do it in some cases by state, in some cases by country. So I did it with CVID. I'm not sure if any of you are logged into the terminal right now, if you can confirm that for me, but I just did it today. So unless they just changed it to VRUS in the past few hours, which I doubt. So I thought this was interesting because if you're trying to make some sort of investment plays based on COVID in some way, shape, or form, this is a pretty good way to get a handle on the virus numbers and the virus impact. And so again, the Go function, that would be what you type into the terminal, CVID. Now, here's what I want to start to do here. So within Bloomberg, one of the most used functions that I have found, one of the largest used functions, is the GP function. What that does is allows you to graph things, and you can then graph things out for whatever you're interested in, right? So in this case here, I'm saying, what if I want to compare the S&P, right? And I want to see how are things changing today versus how things were changing back in the 2008 crisis. Like, what does that look like? And so what you see here is the red and green line, which is the factual knowledge we have here, is how the market changed over time, how the S&P 500 changed over time from the 2008 crisis. Did everyone kind of follow me here so far?
Yeah.
That would be, again, this line right here. Right, all along. The white line here is then I imposed on that same line over time what the S&P 500 has been doing since February 1st to October 1st. And if you notice here, in the beginning, everything was going in the same direction. So obviously at this point, this is not August to October for the 2020 period. This would be February, March, April, right? And then what happened is that right around March and April was when we started getting the stimulus, right? And so then you notice this pretty marked departure of the 2020 time period, COVID, versus the 2008 crisis right here. But now, what you're noticing is that this is becoming flatter, right? And it's really a reflection of this theme I've been pushing the past 2 weeks of how the market actually does need stimulus right now, and it's not getting it. And at best, all we can say is let's wait until after the election, and then I guess wait for those people to get into office. So wait till January. The question is what is this going to look like, for the next 2 months? Is it going to go down or keep going straight? It's not going to go up. I mean, it's going to go down or it's going to go straight. I guess it could go up if Democrats sweep every office and Trump just steps back and doesn't cause any problems. Then maybe it would just go up because we'd all of a sudden have certainty. But what I hope this chart shows you is that there is some concern right now among market participants about the fact that this is not repeating 2008 anymore, and not in a good way. Because what you see here is that while this downturn was longer, it did set the stage for the long recovery that we experienced for over a decade. Right, slow and steady, the economy did grow throughout the 2010s. And I'm not sure if we can say that same thing for 2021. But by far, the trading function I use the most in Bloomberg is trading signal, TSIG. It's just a really cool function. What you can basically do is set it up for various things that you think are going to impact the market. I'm not sure how this is going to look on my iPad here. Let me just see here if I can, what it looks like here. But again, if any of you are logged in to the terminals at the same time, you could be typing in things. Yeah, it's not. But this is why I took snapshots. Now it just tells you how to set them up. Okay, well, I'm not going to worry about that. Let's go back to this. So if you type in TSIG, what's really cool about it is, as some of you are seeing, you can set it up for different events. So I set one up for recessions. And I looked at 100 years of recessions, the data that we have for the past 100 years of recessions, and what is happening. The concerning thing here is that the current recession that we're seeing right now, that in the past 100 years, we've had 15 recessions. And that in those 15 recessions, that what we're seeing here is that overall, we generally experience from June 30th of 1920 to June 30th of 2020, that these recessions, so we are now, if the recession started in March, and this is now soon to be November, so we're in like month 8 of the recession, right? That on average, we're basically seeing that on average, the markets are little moved 8 months after a recession. That it's highly unusual, as we have today, to have a market that's up so much, right? That'd be some of these anomalies, some of these extreme situations where the market's up 30% 8 months into the recession. That's just unusual. More likely than not, we should be below, but if for the most part, we're basically running on a market that's little changed, really, until the recession resolves itself. Now, what this did, when I started looking at this, then I was like, okay, so I put in that trading signal of the recession, and I was trying to put it in relation to this, where I'm just going to erase this here so we can look at this cleanly here. again, I'm just going back to this issue, and I'm sorry if I'm harping about it, but it's just continually confusing to me why this would be the case. Why is the market up so much? This would look to be like a horrible market to be involved in. So how do we make sense of this? When even the data tells us that the past 100 years of recessions, that the average is nothing, no change at all in the market. Certainly not the kind of growth that we've had in the market since the lowest parts of the market in back in May. March, late March. Well, it turns out that what you can do is there's a Bloomberg function for this as well. The Bloomberg function would be RRG. And this is a really cool function as well, because what it does is it allows you to see within the S&P 500, we can look at the different industries and we can try to get a sense of what industries are growing versus which one are not. So when I ran this about a week and a half ago, what we could see here is that energy is doing pretty poorly. Don't really worry about these scales. Basically, the best place to be is in this corner. This is the worst place to be, okay? You want to be in an area where things are growing. And you see that growth in industrials, information technology, and disposable consumption, discretionary consumption. So it gives you a pretty good sense of where things are going in the market as a whole, and being able to see who are the industry winners. Energy is doing poorly. Utilities are kind of doing okay, not great, but okay. Telecoms are doing okay. Healthcare is doing okay. Finance is doing okay, right? But again, industrials, information technology, discretionary consumption is all doing well, relatively speaking. And you can get this from, again, the go function of RRG. But that still didn't make sense to me, because how do you take a pandemic, right? A healthcare pandemic. Why is healthcare doing so poorly, right? And probably more surprising for me, why are some of like the safest things, like telecoms, utilities, even finance, because this isn't the finance-driven recession, why aren't these three doing better, right? Why is it information technology? I mean, yeah, people are doing more Zoom and cloud storage is more important, but really, I mean, doing a Zoom call actually existed before COVID, but people doing things virtually certainly existed before. Why are these three doing so well? Bloomberg can tell us this. So here's what I did here. I just took out the top five stocks within the S&P 500. That would be Facebook, Apple, Microsoft, Amazon, and Google. And if you do the GP function and you graph it out, so what I did was I separated out those top five stocks by market cap versus the other 495. In 2020, whereas the top 5 companies have given a return of 53%, the rest of the market has generated a return of 8%. And I just think that's amazing. It explains partly why, even in my own performance, why I'm not beating the market is because I haven't thrown everything as much into that, right? And it's hard if you're not like going like all in on those 5 companies. That's driving most of that year-to-date performance. I'll pause here. Does anyone want to say anything? Anyone find this interesting or think I'm like, I guess I should have added an S here. How do we make sense of all this?
It's definitely surprising. Like it isn't what you expect the market to behave.
Yeah, I mean,
That's-
but look at that difference, right? That difference certainly wasn't that big. But really, do we think that, like, I mean, some of these, like Google and even Amazon, right, which the cloud is their big revenue, so they're all kind of driving this. But what is it about those 5 companies that's driving such a big difference in year-to-date performance? Like, what is that? Is that safe? I mean, as I was just kind of, again, thinking about this step by step and trying to look at Bloomberg, what does Bloomberg tell me the answer to this is? So let's just go back here. Start out with this. Like, dude, virus is bad, right? Then I got here and I said, okay, this doesn't look like the last recession. Something different seems to be going on here. And in fact, something is different going on here, not only compared to 2008, but compared to all the recessions we've had in the past 100 years. Something different is going on. We're in the green. And that different thing that's going on, the cause of that different thing that's going on has to exist in one of these 3 segments. Because these are the 3 areas where the market performance is. Everyone following me so far?
Yes.
Yes.
Yep.
And where I'm at right now then is, okay, well, if that's the case, then I just said, okay, what are the big information technology companies out there? Because that one is really easy to find, right, in consumer discretionary. The top 5 companies are the ones that have driven all of those returns. And again, I just plotted this out with the GP function. So what's really cool about Bloomberg is you can create your own index. So this is really cool if you have a portfolio, because basically you can weight what's in your own portfolio. You can weight it and create your own index that you could then basically track every day and compare it to the other indices that we know are more popular, like S&P and NASDAQ and all those. So that function is CIXN. So if you want to create your own index that you can then compare, that'd be CIXN. So I just created one that was the top 5 companies. That's all that it is. Those top 5 companies, last year approximately, so last October 2019, had a market cap of $7 trillion, whereas today it's $30 trillion. In 1 year, we've gone from $7 trillion to $30 trillion in market capitalization for those 5 companies. Market capitalization means how many shares are outstanding and what is the current price of those shares. That simple multiplication. As a percent of the total index, of the total S&P 500, whereas 6 years ago, those top 5 companies, 6 years ago, so 2014, those top 5 companies represented 9% of the total market cap of all the S&P 500 companies. Today, it's almost 23%, and that's what this graph is showing here. Is that today, it's almost 1 in $4 in market cap in the whole S&P 500 is in those 5 stocks. And if we keep on that trend, right, because it's a bit exponential here, it's going to be 43% by 2024, meaning almost close to $1 and $2 of market capitalization in the S&P 500 is in those 5 stocks, right? The big ones, right? We're not even talking Netflix here, right? We're talking Microsoft. We're talking, again, Microsoft, Facebook, Amazon, Apple, and Google. Those 5 companies today represent approximately $1 and $4 in market cap on the S&P 500. Crazy, right? This part is really cool. I just put this in here. Some of you are going to really like this function. I'm just going to post the video here. You know, Cody, Elijah, Jasmine, if one of you want to make a video like this, I would encourage you to do it. That way we can post it for everyone's Bloomberg purposes. I didn't make one. I mean, I didn't make a video. I know how to make this. But what EQBT allows you to do, which is really cool, it allows you to back test different trading strategies that you would have done and what would it have returned, right? It seems pretty reasonable. And so if we do this for 2016, all the way back to 2016 for those top 5 stocks, right? Here we're seeing in terms of total returns, right? I mean, it's just crazy. I don't know really what else to say. On a scale, the returns that the positions have more than doubled in value just since 2016, and on a risk-adjusted basis have done even better. That would be our Sharpe ratio. That things have even gone better than that. So as a trading strategy, what EQBT tells us about those 5 stocks, which we already kind of know already, is that you don't have to have been that smart to have made a whole bunch of money the past 5 years. All that you had to do is buy those 5 companies. That's what the equity backtesting function, EQBT, tells us. And it's certainly true today. But the weird thing here is that now I am old enough. I started investing in 1999. And so right when I started investing is when the internet stock bubble was kind of coming to that point. So if we look here and we do some of the back testing here in terms of comparative returns, and what we can see here is that this is 99 to 2000. And what you see here, this is before, sorry, let me write this here. This is before the bubble burst, and this is after the bubble burst. If you look at before the bubble burst, you've got the NASDAQ, you've got the S&P, you've got the Russell, which is the small caps, you've got the S&P mid cap. Everything's showing signs of strong growth, right? Especially NASDAQ, obviously, because that's where all the tech was. Then the bubble bursts, right? And here we're only talking a 6-month time period here, right? This is the 3 months before. This is the 3 months after. In the 3 months, sorry, not just 3 months, sorry. This would be the 1 year after the bubble's bursting here. This is 3 months before it burst, and this is the 1 year after it burst. In that 1 year after it burst, the NASDAQ is down 60%. From being up 80% in just 3 months alone, right? In 3 months. Up 80%. In 1 year, down 60%. More or less for the NASDAQ. I mean, it's just, that's what a bubble looks like, right? If we're trying to look at it in terms of the equity indices, that's what it kind of looks like. I don't see a lot of ways that it becomes very different from either back testing the equities, those 5 equities, or looking at it here. Now, the reason why one would construct something like this, right, where I do comparative returns in 2 different indices, is because different indices focus on different things. So as we just were looking at here, NASDAQ is more tech heavy. NYSE is like more like big industrial companies. In fact, there's very few companies, tech companies in the NYSE. Really the biggest company that's on the NYSE that really has any tech features would either be Microsoft or Salesforce. Those are really the 2 biggest NYSE tech companies. Otherwise, everything else is in the NASDAQ for the most part. And you can certainly see it in the S&P. Look at that difference here. I'm seeing this here. Let's look at the S&P 500 and let's look at the Dow Jones Industrial. And let's just look at it from January to today. Again, tracking close, tracking close, tracking close, tracking close, tracking close. To now, a distinct and permanent and sizable difference between the 2. Whereas the S&P 500 has returned 10% this year thus far, the Dow Jones has returned 1.39%. So nothing, right? So in some sense, what this does is it should give us some pause, right? That things, we hear the stories of like Tesla and Microsoft, well, not Microsoft, Facebook and Amazon, even Netflix, Zoom. We hear of all those where it's quadrupling in value. Well, that'd all be in our S&P 500, which again would reflect 10.74% annual rate of return. But Exxon got dropped from the Dow Jones Industrial, from the NYSE, just because it was performing so poorly. And so it's another way to start to think about why there could be a bubble that possibly exists here in these indices, that these kinds of differences should not be sustainable. And again, it is significant. So the Bloomberg function here would be COMP to do your comparison. And I just compared over the past 3 full years, S&P to Dow Jones Industrial. Look at that. That over that time period, the S&P 500 had an annual rate of return of 15.25, and at the Dow Jones Industrial, 15.71. It's a very small difference between the 2 on an annual basis from 2016, end of 2016 to end of 2019, those 3 years. That now, again, it's different this year. It's anomalously different, significantly different. How do we understand that difference? And probably the most frustrating thing for me here in this goes back to the thing that I had actually wanted to talk about. I said I wanted to make a lecture about it 3 weeks ago, and we didn't get to make it yet. But it goes back to, makes me seem like the old fuddy-duddy in the room here, but going back to PE ratios. For the top 5, now that I created my index, right, so again, what I did is I had my index that I created, CIXN, and so then I can create my top 5 index versus the other 495, and I just looked at what is the PE ratio, price to earnings ratio. How much are you paying in share price for future earnings? In the top 5, you're paying $52 for every dollar of earnings. And the other 495, you're paying $38 for every dollar in earnings. Are the top 5 that much more valuable? I mean, I don't think they are, but that's me, and clearly the market thinks I'm wrong. I mean, if anything, that difference has actually been tightening up a little bit. But geez, how do you sustain that? Right? I mean, fuck. I mean, I don't know how you sort that out. All of this is being driven, going back to, I just was having a lot of fun. All I can say is I was having a lot of fun on Bloomberg. And I'm showing you this all because after a while, like maybe by the end of this, a full 12 months of doing things in Bloomberg, maybe you could start to tell a story like this. But going back to this issue of then, okay, what's going on in those top 5 companies? If they're in the information technology and the consumer discretionary, what is going on in them as compared to the other industries? Again, let's actually put some numbers to this. That since January, if we look at all of the major components, that info technology has had a 30% rate of return. Consumer discretionary, 25% rate of return. Telecoms, 10%. Healthcare, 3.7%. A loss of 1.4% for industrials, a loss of 8% for real estate, a loss of nearly 20% for financials, and a loss of 51% for energy. Those are the major components, the major sectors of the S&P 500. So you're going from a high of 30% to a loss of 51%. Those are our two extremes. This graph right here, should tell you of why diversification is so very important, right? Because even though it looks like this today, don't read this to think that you should never buy anything ever in energy, right? Because if you were in energy in 2003, dude, you looked like the smartest person in the room. 2004, fantastically great. It's just that energy sucks right now. Information technology looks great right now, but in that same time period, 2003, information technology sucked, right? So if anything, it goes back to why maybe you would do an ETF, an index fund, or why diversification is so important. Because within this function, right, you can create this for different time periods. So you can look at what the sectors look like over time, and it will look different in different years. It's just that energy is the loser, information technology is the winner. So you can't just have one tried and true way of making money. You can't say AMD is always going to be the way to go. You can't say that Johnson & Johnson's always the way to go, or a utility company is always the way to go. It's clearly not the case. So either you throw your hands up and you just say, fuck it, I'll just buy something of everything, or you try to be more dynamic and you shift among these sectors over time. Best way to figure this out would be in the Bloomberg, you can just type in MEMB. That would just tell you what's their weighting in the different indices. I think this might be the same function in Bloomberg. I think. It is not. Fuck you. Yeah, it just doesn't let me do it on
Is there data
Okay.
on like, or any significance to the amount of people in the market that are buying shares individually versus buying ETFs and then owning shares that way? I mean, they're not really owning shares, but
Yeah, that's a good question. So it is in fact the case that passive investments have grown in size, because that's basically what you're referring to, right? Is passively owning basically funds through an ETF or an index, an exchange traded fund ETF or an index, or a mutual fund, versus an actively traded like hedge fund or an actively traded even an actively traded mutual fund or individual ownership. I mean, the data suggests right now, from what I'm seeing, is that over time, it's absolutely the case that there is more in passive investments, dramatically so over the past decade, than there's ever been. So people are truly going to Vanguard, right, and taking the advice, of going with Vanguard rather than American funds or MFS, Massachusetts Financial, right? Those are two mutual fund companies that do more active investing, as opposed to Vanguard. But the numbers for individuals owning funds, like your Robinhood-ish kind of things, it's still not significant enough to really be driving this. So the only thing I could kind of take from this, Cody, as a way to kind of think about this is, um, you know, just plain old shiting here with a regular old, Bloomberg terminal. I've been able to determine that this year the winning strategy has been to be in the S&P 500. And that not only has it been to be in the S&P 500, but that the winning strategy has been to be in those top 5 stocks. And that's how you can make money for your fund. And I have that flexibility if I'm in an active fund, because I can just say, I'm only going to invest in these 5. That's what I've decided I'm going to do. Whereas if I'm in a ETF, I have to buy something of everything according to its weight, which would mean, I'm just going to take a guess here. One of the most popular passively traded S&P 500 funds, that would be the Vanguard S&P 500 ETF, VO. If we look at it on let's just look at it on a year-to-date basis. Yeah, dude, I mean, it's basically flat, right? If you've invested in the S&P 500 index fund, you've done exactly the same as the market, which is exactly this, which exactly reflects, right, something where you've had to own the great stuff and the shit, right? This. You've basically broken even. As opposed to, I don't even know if there's, let's see. Sure. The Vanguard Information Technology ETF. Okay, so this would be an ETF by the same firm, but it invests in information technology funds of various types, and it has increased by nearly 30% this year. I mean, there's no way about it. This has been the winner way of doing this. Now, go back to what you were asking, Cody. This would be passively traded fund. It's just that it was passively focused on the winning sector, right? And I don't know how you would have predicted that unless you were just really smart.
As people are passively investing, they're going off the assumption that the market is behaving normally. right?
Yes.
So I'm assuming this is a big problem as they put more into these passive funds because it's not, I don't know how to say this, like it's a blanket solution to a problem. I don't know.
Yeah, no, I get what you're saying. I get what you're saying. Yeah, no, I mean, it's hard because, I mean, it just becomes one of the points where you almost sometimes just throw your arms up and say, why am I doing this, right? Like why am I, sorry, I'm just trying to see here. Make sure everyone's in here that needs to be in here. Just adding Michael Freeze. Okay. No, I get what you're saying. I mean, it becomes a frustrating point because how would you have known, right, to invest in that one fund? And you wouldn't have. And for those of you who do remember when I talked about it an entire year ago, so for those of you who had me for what was it, contemporary economic problems last fall? Do you remember that? Like, Cody, you were in that class. Freese, you were in that class because that's when we first met each other.
I was in that class too.
That's right, Levi. You were in that class too. That's right. I mean, do you remember that? Like, do you remember that one student, the one that worked at our Research Corp, the one that did the HR stuff? Do you remember?
Yes, I remember her. Yeah,
remember?
I
And
her.
I even told her. What was her name? Janice or Janet? Wasn't it, or something like that?
I don't remember. I remember she
It started with a J.
was.
What?
I just remember that she would usually hang back at the end of class and like get into like heated discussions about HR
Exactly.
and how that.
Exactly. So, but one of the things, right, was that she was saying, you know, Shredding, what should I do? This is what my funds are in. And I remember giving her the advice and saying, if you don't want to worry about it at all, the best thing I can tell you is just VOO. Now, was that good advice? Yes, in a normal market, that was actually okay advice. I mean, it wasn't horrible advice, but it wasn't horrible advice. But I don't know, maybe she's going to slash my tires now because, right? I mean, it's done jack shit. It's done absolutely nothing year to date. It's increased.
She slashed her tires. She's doing bad HR.
Yeah, exactly. She's doing bad HR. I mean, it's returned, you know, year to date, even in a, well, okay, let's look at this on a 5-year basis, right? On a 5-year basis, even with the pandemic, it has returned 62% over the past 5 years and has required no fancy trading. So going back to Cody's point, which he might be trying to make here of like, you know, when you're engaged in this kind of passive investing, is there a way to be a winner? Well, it looks like over the past 5 years, you would have been somewhat a winner. And if we take out the virus, let's just take out the virus. That doesn't actually make much of a change here. If you take the virus out here, over the past 5 years or so, it still returned 60% over that time period. And you didn't even have to be very smart about it. Although, I bet you I don't know, maybe I should have told her Vanguard, right? Because Vanguard has then returned 134% for the information technology ETF. But look at this, right? Although there's been some recent recovery here, for the most part, you have seen somewhat of a concern in the trend line that things are going down a little bit now, from sort of the excess in late August, early September. So Cody, this probably does not answer your question at all, but this would be like your classic VGT, VOO. Those would be your classic passive funds. Then for your classic actively managed, expensive mutual funds.
I'm familiar with the Vanguard funds mostly. But it seems like you're not gonna, well, if you get VGT, you will have beaten the market. But if you get VOO, you're not gonna win or lose. You are the market.
Correct. Right? Correct. Exactly.
If your
now
goal
this
is
one would be, and this would be an actively managed fund. So this would be American funds. You can see here the management fee is much more expensive, 0.41. Yet somehow, even investing internationally, they still returned over 6%. So they obviously paid for some pretty good returns. But over those 5 years, despite paying more in a management fee, it wouldn't have been advisable because you did 21%. It's just because you lose a lot of money in active trading. Sorry, I'm just trying to look here for American funds. Oh, I know one. CABCX. Yeah, here's one. Okay, so this would be Capital Income Builder. This would actively invest in companies that generate capital gains and dividends. So this would be largely large cap, but then some mid cap, probably not any small caps. If we look at this year to date, they have lost money, nearly 9%, and yet you're still paying 0.23% in a management fee. Over the past 5 years, it has also basically not done anything for you at all. Like, wouldn't that be frustrating? I mean, that would be frustrating to me. Yeah. Before I go back to the slides, what questions do you have so far? What things are you curious about?
I don't want to make it all about index funds, but like with the introduction of fractional shares, what is the incentive to go into index funds when you can just kind of make your own with fractional shares?
Yeah, there isn't. No, I mean, seriously, this whole idea of fractional shares, my understanding of it is that basically technology has become cheap enough now that the big financial firms can do these small transactions and cover the transaction fees that come with buying like $2 worth of Apple, right?
Dave, is that you?
Like, very, very little. Sorry, I'll mute everybody here. Sorry, I'll shut everybody up. Sorry, I'll shut everyone up. Okay, going back to this. So my understanding is that the fractional shares, all that you're really doing there is you're making it so cheap to make it sexy to own something, right? So then you can say, I own Apple and I only put in $5 versus I own something, I own, part of VOO, right? The S&P 500, right? It's just, I don't know. It just goes back to that notion of like feeling like you want to put more money into the market because you actually own the shares as opposed to owning shares of something that owns the shares. Does that make sense?
Yeah, I kind of see your point.
Yeah, I mean, so really, I mean, it's just really you're saving the small management fee that Vanguard charges, but that management fee is so little for you to give exposure to all 500 stocks, right? Because again, you want to avoid this situation, right? Where you bought fractional shares in ExxonMobil, and that's the loser, right? And the people that bought fractional shares in Facebook right now are looking really smart. What I'm saying is that they may look smart again next year too, but they may not. You just don't know. And whereas everyone would have thought back in February that healthcare would have been the winner, it's done jack shit for you, right? 3.7%. It hasn't done very much for you. I'll wait until someone asks something, but one thing that I found really cool, which was actually only because I don't know what the function is here. It's not an equity. Yeah, well, on your terminal, not in the iPad, but in your terminal, you can actually do something really cool that Russell was trying 2 weeks ago. I just want to jump to that slide and then I'll come back to this. I'm going to come back to these. Don't worry. I'm going to come back to these. BCY. So let's ask it this way. Are you like a Russell? Do you want to pick up the really shitty companies out there and try to make a bet before they die that you might make some money right before the moment that they die? If you're like him, type in BCY and you can actually start to see not only the bankruptcy filings, but you can actually start to see what companies are most likely to declare bankruptcy. Right now, those companies most likely to declare bankruptcy are The Gap. That would be L Brands, which owns don't they own like Victoria's Secret, I think, and a few of those others. General Motors, Ford, Expedia, Carnival, Norwegian, Royal Caribbean. Meaning you might be able to pick up a bunch of those shares pretty cheap because there's a significant risk that in the next 5 years, they will no longer exist. And that in the case of Royal Caribbean, Norwegian, and Carnival, there's a not there's a somewhat reasonable chance that they may declare bankruptcy. The way you can do this again is under BCY. You can then, I want you to focus your attention here on credit. So within an index here, so I'm looking at consumer discretionary index, I then went into credit and I can look at the 1-year default rate, the credit default swap, the credit default spread. I can basically look at how risky is it to invest in Royal Caribbean. How risky, right? There's got to be one of you in this class that has bought shares in Ford. I say that because the dividend is just so attractive. Someone look it up. I'm not at the thing right now. So someone type it in ticker symbol F. What's the dividend on ticker symbol F?
Dividend is 3.68.
Yep. And what's the amount?
Oh,
What's the amount of the 3.6%? So would it be what, like 80 cents a share, 90 cents a share?
I have no idea.
Let's see. Sorry, I'll go back. Sorry, I'm being lazy. Let's just say let's do an analysis here this way. Okay, so let's go into Ford. Okay, so here I am in Ford. Looking at it around here, we've got a share price
Saying
is
about
$7.92. Yep. So, and then, yeah. Let's go back to yield here. Yeah, and in some of these cases, actually, did they suspend their dividend? Why am I not seeing anything?
Yeah,
They suspended their
for some reason
dividends.
it's not showing on mine either.
They suspended their dividends before or right after their last dividend give out.
And what was that?
That was like back in March, right when the corona hit.
Really?
Yeah, when the
Wow, I
COVID
really have
came,
not-
they suspended dividends.
I really have not watched this in a while then. Wow. Okay, so whenever you see a really good, let's look at another one that, like, let's look at this other kind of stock idea, right? So ticker symbol T for AT&T. Now this is one, as many of you have known here, almost $27 a share, but it's got a dividend yield of over 7%. So you'd be like, damn, right? I get like a fraction of a percent at First Hawaiian Bank. Why don't I just put that money into AT&T? And even if I don't make any money on the share price, I'll make 7.73% yield that I can just cash out. I don't have to buy more shares with it. I can just cash it out. Well, what you'd be concerned about is how strong are the financials of this company, right? What is it? Is it going to be able to continue to be able to pay this dividend? There's actually, if we start to do this kind of analysis here, there actually might be some growing concern that they might not be able to. And we say this because if you start to look at things like their earnings per share, right? It's not growing. They're not getting any growth that way. Their net income adjusted is falling. Their EBITDA is falling. Their profit is falling. Their revenue is falling. Right? I'm just looking here at financial analysis. Go on. No? Okay, so everything is falling here. If I look at this even on a quarterly basis, right? Even on a quarterly basis. Now, this one's a little harder to do because different quarters are going to have different levels of strength for different kinds of businesses. So it's actually probably not useful to do that. But again, on an annual basis, the company is getting strategically weaker, financially weaker, which we can see that's reflected in the share price. It has been going down, but it also is going to be reflected in the fact that there's going to start to be some concerns that they're not going to be able to maintain the richness of that yield, which would mean that they would cut it, which is what Ford did for a while until it never went bankrupt actually in the 2008 crisis, but then throughout the 2010s, it kept ratcheting up its dividend. You had companies like, I don't know, even like Southwest Airlines, which paid out a dividend, which doesn't anymore. Let's look at that. Right? The dividend is gone, wiped out because of COVID. But again, you're going to start to see, geez, look at this. I mean, I'm not even, look at this, Russell, look at this.
What is that?
So in bond trading in Southwest. Interesting.
It's funny. I remember Love was one of my first big losers years and
Would
years
you buy
ago.
it?
Had to have been, let me look. Had to have been cheap because I was trading this maybe around 2010.
Ooh, so you got it for about $8 a share, $9 a share.
Yeah, so check this out. So back then, right, I was still buying cheap shit, but LUV, let me look at this.
You would have bought it for about $10 a share.
Yep.
Was my
And
guess.
I remember it went down to like 8 and 7.
And that's when I got into it. I got into it at like $7.82 a share.
Yeah, and I was losing like $700 at the time, and that was like huge for me.
Yeah.
So I just cut my losses, and look what
I
it did
probably
right
bought it
after.
from you. That's when I probably bought it from you.
It did. It
But
went
I
to
sold
the
it too eventually anyway.
it went to the moon, dude.
But see, but here's what I want. I mean, if anything, if this class doesn't show you, right, that there's lots of ways to invest in the market. And I know that equities are like the really cool way to do it, right? And you can do it with Robinhood and it's really easy. But there's money to be made in the bond market as well. Pretty sizable amounts of money. Let's look at what some of these bond offerings would be. Let's see what's going on in the bond market.
That's so funny. Like, you probably did buy those shares from me.
Probably. Let's see here. Let's go back. Back. Okay, let's look here. So this would be a note that expires in 2030. God, look at that. This is on it's basically people are paying right now 97 cents on the dollar for Southwest Airlines in 2030. So what, again, you're making a bet that it's not going to go bankrupt before 2030. And if you're willing to make that bet, oh, this was just issued in February. That's crazy. Okay, let's look at something older. So what I do here, the way that I typically look up a bond offering is that for an equity offering, I start to type in its ticker symbol. Then I scroll down, or in the Bloomberg function, you can then see here that what I can see are the different bond offerings that they've made. So 2027, 2025, 2023, 2025, 2030, probably even more here. Let's look at something that might be a little older here, 2023. No, this is short-term debt too. Wow. People are really expecting that Southwest might declare bankruptcy. I mean, the financials do look really bad, but
Short it.
yeah, or make the bet the opposite way, right? Buy
What's
these
the
bonds.
what's the price? $39. See, that's the thing. It's not that I look for bankrupt companies. It's just if the price is cheap, they might be going bankrupt, but a lot of times they're not. And I'd rather them not, because I don't want that risk on my position. I'd rather just buy in it to a cheap stock and it not go bankrupt, obviously. And throughout my trading career, I've never, ever held a stock into bankruptcy, ever. It just so happens that some of these stocks might go bankrupt.
But
I'm in everything. I'm in blue chips. I'm in cheap shit. Doesn't matter really.
So what is this saying here?
AMD had earnings today. Let me see.
See, I really wish that we actually had the actual class, because then we could have lap times. We could be talking about trading ideas. rather than always having to fill it into a class period.
It's COVID.
Although I'm still
fucked everything
curious, someone on campus got COVID, so that's why I'm saying, like, I thought about the risk of, like,
But you
having
see
class.
that though, like who
I
got
don't know.
COVID?
I don't know.
You know what I
Does
mean?
anyone,
Like,
does anyone have that class? Does anyone have a class where someone got COVID?
no,
Someone had
nobody.
to. Someone had to have.
Nobody
There had to have
ever
been
knew anybody.
15 people had to have been in that class at least. And what do? Do they just not have to
But
go
I
to class
thought,
now?
I thought there wasn't any class on campus.
No, but there are, because there are people
There
on
are?
campus. And one of the labs,
So
like
you're
physical
telling
labs.
me that they canceled the entire semester for us to go to campus, but there's still some classes going on, and it just so happened that the class that is on campus, someone gets COVID.
Exactly.
Sounds kind of weird.
Maybe. Yeah, I don't know. Like,
I just want to know
oh,
who.
look at this. Dude, look at this. If you're not, look at this. The ship is taking on water. That can't be good.
Think or swim, buddy. Think or swim.
Yeah. Well, I think, again, everyone's just kind of waiting for the election. Okay. Okay. It's 6:32. I want to make sure that if we don't take a break now, we'll never get one. It's 6:32. Let's take a break till 6:45. So I'm going to pause everything till 6:45. And then I'll come back on at 6:45. Okay, I am back. Is everybody there? Can you all see me?
Yep.
Yes. I don't know if this can be. Wait, I'm going to change. I'm going to get rid of my background setting. Look at this, Karen. So this is in the Bloomberg magazine for this week, and it was showing Disney and showing like Disney's not the happiest place on earth. Everyone's looking sad, and the Disney looks like it's all dark. But again, I get a lot of great trading ideas, although it makes me seem old-fashioned, that I get them from a physical magazine. But just look here. So look at this, right? So this is the theme park revenue part I was telling you about here. So theme park revenue for Disney down second quarter of 2020. Then if we look at Universal Studios, also down. And then if we look at Six Flags, also down. Unfortunately for Six Flags, the top two have a big media presence, and other ways to get money. Six Flags doesn't really. And some of you have probably never been to Six Flags. I'm from the Midwest. Six Flags was the closest thing we had to a Disney when I was growing up. So, okay, let's go back.
Speaking of Six Flags, if you go to their ticker,
which I'm sure, they're probably pretty junky. It's probably your style.
SIX, $21.
Really? I'm surprised. I'm shocked, actually.
$10 in the sell-off earlier this year, the COVID sell-off, $10 low. Yeah, I grew up in Jersey. There were Six Flags everywhere.
Oh, yeah. There would have been a Hershey Park, too.
It was fun.
Did I tell you I had my bachelor party in the old AC? Just like everyone from the East.
That's a legit place to have it.
Dude, it's where every person from the East Coast has their bachelor party. Right?
That's the East Coast Vegas.
Oh, man. Atlantic City.
That's where Trump's famous...
Yeah, one of his properties is at, yep.
Well, one of his famous bankruptcies.
Yep.
The Taj Mahal and that whole entire complex went through major problems. It's so funny though, because people just like kind of like isolate it, but when you like look at that time period, like there was a recession, real estate prices were actually going down, like stuff like that people don't really put into the equation. But yeah.
So look at this. People are really chasing the yields that are coming from Six Flags, thinking that, yeah, like you could have picked it up really cheap. Maybe just maybe because people are expecting that, like, people aren't going to travel to Disney, right? They're just going to go to Six Flags, which is like maybe closer to their house, maybe? I don't know.
Wait, like what made you say that though? What are you looking at?
Here, what I'm looking at here is, let me share my screen here. Go back to sharing my screen.
I can't believe they're still in business, honestly.
Me too. I mean, I remember having a job as a kid picking up trash, like in junior high. I mean, it's like one of those like early jobs one gets.
Yeah.
Here's Six Flags note issued that comes due 2027. Year to date, it's up 80%.
So how does this work? So I'm looking at a few things on this screen. I'm looking at the $94, if that is dollars. I don't even know if that's dollars.
Yeah. You're buying
$94.83.
$100 for $94. Yes, $94.83.
So, okay, and then on the chart, it's showing 649.
Yep. So right there, that would be your yield.
Got it.
Yield of that bond, taking into account the fact that you bought it at a discount. So we could trade it. We could change it this way. I could look at the price, right, and from its depths.
Yeah. Okay.
The price is down.
So that was the
11%.
yield.
Yep.
Before.
And so what that's telling you, the yield, is that this has obviously become riskier, that the yield has increased 3% on this bond. Exactly.
So I would get, if I were to buy, how does it work? It's not shares, right? Because it's a bond.
Nope, you're basically buying, I mean, usually it's offered in like $5,000. It's usually the smallest lot. So like $5,000, $10,000. But then they break it down for every $100. You're basically paying about $95 for every $100 bond.
Wow, I didn't know they were in lots. I didn't know that.
Yeah, basically, yeah.
So how? Okay, so if I wanted to buy this, how, like, what's the minimum price I would pay? It would be 94.
About $94, yeah, $95. There's a pretty big secondary market for bonds in general. I mean, it's not going to be as quick as like buying an equity where it's like instantaneous that the order is filled, but your order would probably be filled that same day.
So it's like,
as long as it's traded somewhat.
Instead of buying the stock.
I mean, here's what I'll say. Like when we just had to put together the money for our down payment, a big chunk of it was me selling some of my bond holdings. I think I sold it last Friday. It all filled by Monday.
I'm just trying to like wrap my head around the logic of, obviously I'm not well versed in this, but why would someone buy this bond for $94 instead of the shares for $20?
Because what you're hoping to get here. So if you look here, it says at the very top, 5.5, 04/15/2027. So basically this bond matures on 4/15/2027. It's a $1 million initial bond offering. So that's the entire thing is $1 million broken into $100 blocks. Those $100 blocks, if you bought them when the bond first was offered, $100 blocks cost $100. Okay. That date it was first issued. Then over time, right, it's now deviated from $100. Just like when an equity comes out, right, it comes out at its IPO price, and then it deviates from that price over time. So it's pretty rare to be able to buy a bond at $100. $100 a bond for $100 because it's going to be different. In this case, this is a riskier bond. Riskier because there's a chance it might go bankrupt. And you can see that there's that riskiness because there's no premium being paid, right? The premium would exist if this was over $100, right? Like if I was paying $102 a share. Like I sold a state of Hawaii bond last Friday, and I think I sold it was for Queens, and I think I got paid $107 for every $100, right? So I made interest up until I sold it. And the buyer of my bond paid me $107 for every $100 I had.
So wait,
Because what they're hoping is that they're going to hold that bond until that bond comes due in, I think it was 2035.
But you're
and it was
not
paying 4%. No, I don't own the bond anymore.
Well, wait.
I need the
So
money.
I guess
When I bought it 3 years ago, I was collecting 4.5% interest, state tax free. So I collected that interest for 3 years. And then last Friday, when I needed the money for my down payment, I sold it in the secondary market. So now I'm no longer am I going to get 4.5%, right? But probably some old grandmother, right, went to her broker and said, I want to buy a bond that pays 4.5% of the state tax free. And he got on the market, secondary market, and said, hey, Shedding is selling his for 107. Do you want to buy it?
And what did you buy it for?
Well, I bought it for 100. I bought it at opening.
So over that time frame, you collected 4%,
4.5% interest, state tax free.
and that was static, like that. It doesn't move, or
correct. Yep. It was a quarterly interest payment. I don't remember what the amount was, but it was a quarterly interest payment.
Basically, you're lending money, you're receiving interest,
Exactly.
and then you sell it back whenever you want.
Exactly. Yep.
Interesting.
But it can go bad, right? I mean, there's a risk to it, right? Because if I
Right.
bought this, so going the other way, right? If I bought this Six Flags Great America, ours was called Six Flags Great America. What was yours called? Six Flags. What?
Shit, I have no idea. Just Six Flags.
So there was Six Flags over
Great
Mid-America.
Adventure.
That was Great Adventure. Okay, because there was
Great
Six
Adventure.
Flags over Mid-America. That was the one in St. Louis. Then there was Six Flags Great America. That was the one outside of Chicago. And what was yours again?
Great Adventure.
Great Adventure. Okay. So this one, the investor would have lost money. The investor
So it's like instead of buying a 30-year Treasury bill at like 0% interest.
Well, look at this. Just look at this. No, look at this, Russell. So at the beginning of this year, Six Flags Great America or Six Flags bonds, an investor would have paid $107 for every $100 in Six Flags shares. If during the crisis they panicked and they sold it in the panic, right? Then it was $75 for every $100 that they got paid at. You can absolutely lose money in this scheme.
But people bought this bond at 75, at 80, right? And
someone did. Yeah, someone said, you know what?
Okay.
I think there's something here.
It's interesting how the bond price moves in tandem with the stock price.
In general, it should, because both should reflect that in bankruptcy, both are going to be wiped out. Even if you're a bondholder, you're probably not going to get anything. Bondholders and shareholders alike will probably lose out. So, going back to Southwest Airlines. So this would be Southwest Airlines, a bond that matures on June 15th, 2027, paying 5 1/8% interest. Issued, looks like the beginning of June. It would have been initially issued at 100 a share. Looks like it quitted pretty quickly. But now it's at 112. So what is that telling us? As a share price, that's telling us that it's probably going to exist, which would mean that the yield should be falling, which it is. Now, why is that? Because if I have to pay $112 for this bond, and a bond is going to pay me 5.125% interest up until 2027, that, right, after taking both of those into account, that in reality, I'm only going to be making about 2.9% interest on this bond. So it's likely that Southwest is not going to be declaring bankruptcy. At least the markets are saying so, or at least it's half as likely as people thought in June. Now, let's look at one company that's a little bit more dangerous in this space. American Airlines. Let's look at a bond at about the same time period. Look at that.
Wow.
Let's look at this from a price terms. Whereas Southwest was $112 for every $100. This is a bond that's paying 3 3/8% interest. Matures on May the 1st, 2027. Was actually initially issued in 2015. That was when they emerged out of bankruptcy. You can now pick it up for $78 for every $100 on a 5-year basis, which we now would have here. I mean, look at that. Right before the pandemic, people were paying a premium.
Not only that, if you look at like the volatility of the movement, it wasn't as much as now. Now it's like this bond moves pretty violently compared to before the pandemic.
Look at that yield. That yield, right, is now paying close to over 9%. Exactly. That's exactly what that is. That is a general agreement that this company is not going to last until 2027. Yeah, it's not going to last until 2027 at least.
I mean, airlines in general, man. I mean, what do you think? Do you think they're...
Well, Cody, you're the expert. Cody, you've watched all those, didn't you say you watched all those, like, YouTube videos from that one guy?
Wait, about what industry?
About the airline industry? Didn't you say you watched a whole bunch of...
I did watch a bunch, but they weren't about like the companies. They were more about the logistics of airline travel and like how airlines price tickets and stuff.
Oh, okay.
Yeah.
Look at Hawaiian Airlines.
Oh, jeez, yeah. Jeez. No, doesn't look too good here. Let's look at this in terms of yield. Even worse than, even less likely of a chance that Hawaiian lasts. See what the power is of Bloomberg, right? I mean, none of us are watching news stories right now that are saying Hawaiian's about to go under. And it's not like it's about to go under, but it's like someone saying to you, I've got stage 2 cancer, right? Well, it's not like stage 1. It's not like nothing, but it's something, right? And eventually it's going to become worse and worse and worse. That's what this is. Like, this is seeing a company slowly die.
And they have the news to the right, and I'm reading it. If you look at the bottom, it says Hawaiian Airlines posts 97 million quarterly loss.
Yeah, and if my memory serves me right, they're burning through about $3 million a day.
Oh man, I don't know. I really don't know.
I think, and again, this is I'm not trying to convince anyone here. I know all the exciting thing is let's all invest in stocks, but there's a lot of really cool ways to make money on bonds. And even if you don't, you're still collecting. In this case, you could buy $100 worth of Hawaiian Airlines bonds, and you're going to pay only $81 for every $100. You're going to get paid the 3.9% interest until 2026 if the company lasts, giving you an effective rate of 9.5%.
I Can you explain that again? Where'd you get the 3% from?
So
Oh, got it.
remember here, you're seeing two different interest rates here. The bond itself, the contract is written that Hawaiian is going to pay you 3.9%, let's say on a quarterly basis.
Okay.
This was a $500 million bond that was issued in 2013. And so it's going to pay you 3.9%, let's just say on a quarterly basis, on an annualized basis every quarter. If someone were to sell that bond today, right, or sorry, if someone were to buy that bond today, they would be getting a bond that's essentially going to be paying them on an annual basis 9.5%. Because they only paid $80 to be earning interest, 3.9% interest on $100. Does that make sense? I'll repeat that again.
Yeah.
That someone paid $81 to buy something that's going to pay them 3.9% on $100.
Right. See, that's the thing
They
about
bought
bonds.
a $100 bond for basically 80 cents on the dollar.
So every time I look at a bond such as this on this screen, you're looking at a few prices, right? You're looking at 81.6. You're looking at 100 because that's the default.
Yep.
You're looking at 3.9.
That's the lot size. That's a way of thinking of the lot size.
The lot size. So $100.
Yeah, that you can't. That you have to buy the Hawaiian Airlines, let's say, in increments either of $100, which is the typical way, or $1,000.
Right.
So here, okay. So let's look at this here. This will tell us here. Okay, so the issuer was Hawaiian Airlines. It issued this in 2013. It matures on January 15th of 2026. Series A, meaning that if things declare bankruptcy, you'll be among the first after everyone else gets paid. Yep.
So
May
the coupon
14th
is static, right? That doesn't change.
Exactly. So it started paying out in 2014. And yeah, and it's 100 issue price. So this is an issue size of 100. But
I'm trying to wrap my head
can't
around
buy $100. You can't buy $100 bond. The minimum bond it looks like you can buy is 1,000.
I'm trying to understand, Shiding, the coupon versus the 9% one.
So the coupon is what is printed on the bond certificate. If you could get your hands on the bond certificate, it would say matures January 15th, 2026, pays 3.9%. Just like I had a bond that says that was from Queens, guaranteed by the state, that paid 4.5%.
Right.
And it was for in increments of 100. And I think I had like $10,000 or $15,000. But I sold it, right? And I got more than $15,000, more than the issue price.
Right.
Which meant, right, that the person buying it, even though it was 4.5%, it's going to be less than 4.5% for them because they paid a premium of like $107 for every $100 of bond. They had to pay $107 for a $100 bond, which means that if the bond paid 4.5%, because they had to pay that extra 7%, that extra $7, the premium is going to be less. The interest is going to be paid less. Whereas this, the interest rate is going to be more than 3.9 because I'm only paying 80 cents on the dollar.
Oh,
got it. So since it's 81, I'm gonna get 9%.
Mm-hmm.
Okay. So it's kind of equalizing. Like if it's at a premium, you'll get a higher interest rate. If it's actually higher, like 107, you'll get a lower interest rate. Is that how it goes?
Correct. Yep. So let's go back to rig.
so these seem generally
Go on.
more guaranteed than the return on an equity would be.
Yes, So
Yeah.
like if you're here's another way of thinking of this. Investing in bonds is like doing dividend investing, right? Investing for
Okay.
dividends.
Yeah.
Except here, you're not subject to the dividend being canceled like it was for Ford.
Yeah.
Instead, well, let's do it this way, right?
Okay, what's the risk? How can we lose money?
Well, the risk is going to be the same almost as equities. Even though you've got a slightly higher standing in bankruptcy court, you're also going to probably be wiped out as well.
If
So
I
your risk
buy
is bankruptcy.
If I buy this bond now and the yield is annually 9%, and the stock performs better.
No, let's be careful. So you're it's not that you're going to get a 9% interest. It would be that if you sold it and I bought it from you, I as the buyer, I'm only going to get 3.9%, which is what the bond says, which is what Hawaiian pays out. But because I only paid you 81 cents on the dollar, it's like the equivalent of getting over 9% in interest. But that rate is going to change because let's say I don't want to hold on to the bond until 2026. Let's just say I hold on to the bond until next year, right? The share price or the bond price is no longer going to be 81 cents. Let's say airlines start to take off all of a sudden. They get big stimulus payments. You know, Biden or Trump says we are not going to allow anyone to go bankrupt, right? And so then Hawaiian, we know, is not going to go bankrupt. I guarantee you those bonds are then going to be priced at over 100, which then means that me as the holder of the bond, right, even though I did pay 81 cents, the next buyer of that bond, when I sell it next year, because they're going to now pay, let's say, $105 for every 100, their interest rate is going to be less than 3.9% because I had to pay a premium in the price. So my yield is going to be lower. Let's look at this, Ford. Let's just look at another example here. So Ford right now, looks like people think it's going to exist at least until
a little while
things
more.
are not looking as bad as they used to. I guess because they got rid of the dividend, people think they're going to be able to preserve their cash longer. They've got a lot of capital, so I mean, if anything, right? Airlines don't generally own their capital; they lease it.
What happens when you own the stock, you're collecting the divvy, and then they say they're suspending the divvy? Then what?
Then you get nothing. Then you get nothing. So the other side of dividend investing, right, is that you make money on the dividend and you make money on the capital gains.
Right.
Right. With bond investing, you can make money on changing interest rates and how it might affect your equity, but right, like if I tell you again, like what's the best bond investing, you could ever do, that would be again like something buying like a 100-year non-callable bond, right? 100-year bond.
And would you say that municipal bonds are less risky than?
So here we go.
Never mind.
So look at this. Sorry, is this the right one? Austria.
How is the liquidity of a bond versus equity? Is it pretty
2120. So this is a bond that matures in the year 2120. So do you think that Austria is going to exist in the year 2120?
No.
Well, we don't know. So let's look at the yield on this bad boy. The yield is basically nothing. What does that mean? It means that, at least in the case of Austria, you will only have to pay about $95 for every $100 of an Austrian bond. But that's for 100 years. Look at the interest rate on this bond. Does anyone see what the interest rate is on this bond?
0.
Exactly. So Austria 0, 06, 10, 21, 20, 2120.
Wow.
For a 0% bond, the only thing you can do then is basically make money in this case. You're not going to make anything on the interest rate. All you're going to do is make money on the fact that right now it's trading for less than the issue price of 100. Isn't that crazy?
That's crazy.
Let's look at the security here. Do we get details here? So this was just issued back in June. It's a 100-year bond. You can buy it in $1,000 increments. If you can predict out 100 years, basically, you can buy this bond. Not
But
callable.
You don't really need to because you could sell it some other time, right?
Yeah, you can always sell it. Yeah, absolutely. You can always sell it. Absolutely. And remember, Austria's got the power to tax its individuals, which is why countries, generally speaking, do not go bankrupt.
So that bond you just showed us, that's for like other countries to buy, right? Like I'm not gonna buy that bond.
You could.
What
I
would happen?
could, but I wouldn't, right? Like why would I buy that?
You would buy that if you're an insurance company and you need somewhere safe to park your money.
Okay.
You would buy it if you were a pension fund and you needed something cash, like someplace to park your money. Germany also offers these kinds of bonds.
What happens to like if a country did like no longer exist? Like when West Germany and East Germany was a thing, did they have their own bonds? And then when they combined to become Germany, what happened to the bonds?
In that case, the East Germany didn't. Actually, that was the biggest burden. Actually, is that West Germany, to be able to merge the two countries together, actually assumed all the debt of East Germany. So it was hugely expensive for East Germany. Let's look at a country that's not doing well. I'm just going to guess here. I'm not sure if they even issued any. Zambia.
What the hell is that?
It's a country in sub-Saharan Africa. So here we go.
What?
Right?
Is that like Zimbabwe or some shit?
Yeah, it's somewhere. It'd be north and west of Zimbabwe, I think.
32%. Goddamn.
So Zambia is paying 32% effective interest because you are for 40 cents, a little over 40 cents on the dollar, you can buy $100 in bonds.
What do you think about that?
I think it's incredibly risky because now I'm also risking on the fact that this is probably issued in Zambian dollars, I'm guessing. No, it's actually issued in US dollars, Euro dollars, yeah. But collateral, no collateral, so it's unsecured. The coupon rate is 8.97%, so I will get almost 9% per the coupon, right, per the bond. So I will get 9% interest.
So wait, when it is secured, what does it say? It just says secured?
Yeah, generally secured would be like a bridge or like a building, some physical asset. That's really the only way you can secure something. So for instance, this Queens Hospital bond that I owned was technically unsecured. It wasn't like I owned part of the hospital building. I don't know what the fuck Queens did with the money, but it's not like, I can go in there. It's not like it wasn't like based on like an x-ray machine, right? It wasn't like an equipment bond. So when it was issued back in 2015, this is the cool thing. Bloomberg is going to give you all the data on every bond offering. You're not going to get this in very many places on the web for free. So I can see here that Zambian bonds the Zambian bond that was issued was a $1.25 billion euro-dollar bond issued in 2015, issued at 97.257. Again, paying 8.97% up until 2027. But basically, if you look at the ratings, everyone's saying it's not going to do well. I mean, that's a
Chiding,
pretty.
this is why I like you.
Why?
Probably the only human being right now on
That's looking
Earth.
at a zombie and bond.
Yes.
Looking at this. Yeah. Oh, let's see here. Oh, look at here we go. Here we go. Fuck. Africa could be about to see its first post-COVID default after Zambia skips its interest. And I just picked it. I didn't actually know that they were going to be meeting. Yeah, it looks like this. Looks like after November. So here you go, Cody. Going back to what you were asking. Entirely, one of the risks would be that they can suspend payments. Now, when they do this, that would be default. Which would explain now this is the game of chicken, right? Do they actually do it? Some of you may remember when you took international trade and finance with me. Do you remember back to that like very first day of class and we were looking at Hard Rock Cafe? Do you remember that?
Yeah, in Venezuela.
Yeah, exactly. Let's look at that.
So wait, so this bond being 40% interest, is that why? Because they skipped their interest payment? They're defaulting?
Well, so now here. So now let's just be clear. So this is, you're going to pay $41 for every $100. It's
Right.
going to yield 9% interest as long as they make their payments.
Mm.
Oh, hey, look at this. But a minute ago, we were just told that China, which owned a lot of the debt, has agreed to not get paid back.
Africa
Any
is
interest
becoming
right away.
China.
So we're going to have to imagine here that tomorrow, if I look at this bond, when it's actually trading in the secondary, because the secondary market's not open right now, when this secondary market opens tomorrow, I guarantee you this bond is going to be priced at higher than 41. Cool stuff, huh? And that was just a minute ago. Nowhere else are you going to see that news that just came out of Zambia winning payment relief. Guaranteed it.
I have heard that China has been investing in a lot of African countries. So do you think it would be a smart bet to look at those bonds that China is investing in?
Yeah, absolutely. So, but it's going to be all across Africa, sub-Saharan Africa. Let's just look at, instead of Venezuela, let's look at,
Does North Korea have bonds?
No, they wouldn't have any traded here. Let's look at the Ivory Coast. They wouldn't because of sanctions. They don't have access to the capital markets. So here's the Ivory Coast. Ivory Coast makes most of its money in commodities, which are not selling that well as it is. So this was a bond that comes due in 2028 that right now is actually paying that you pay $105 for every 100. That would mean that the yield should be less than 6.38. And it is 5.4. Wow, that was just dumb luck. I picked Zambia there, huh? And in that 1 minute I was talking about it, that all of a sudden China came to the rescue. I look like a fucking smart ass guy now. Okay. Oh, look at this, Mozambique. Oh man, the best calamari I ever had was in Mozambique. Oh man, it was so good. Cool stuff. Okay, I'm gonna get lost in this if I spend too much time on this, and I can't. If anything, this should really encourage you to keep looking at really cool stuff in the Bloomberg terminals. Just play around with it. But really, I didn't get to finish my slides, although my slides were interesting. I'll post the rest of them but where that story was going, I think I don't want to take up too much of your time. Where that story was going is I did a little bit of a search here. I wanted to compare two things, which you can kind of do by doing this. I wanted to compare what the bankruptcy standings were going to be for the company that owns the mall versus L Brands, which is in the mall. And so I was doing a little bit of an analysis there of who is in the mall versus the mall itself. And it turns out that the mall is a worse business to be in than the retail side of it. That actually, L Brands is actually, which is right, Victoria's Secret and all the other parts of L Brands is actually a better buy on the equity and bond side than Simon Property Group, which is part of the, owns the mall building itself. So I did a little bit of an analysis of that. Kind of look at the Go symbols for how you can play around with it in Bloomberg. But you know what? I kind of interested in doing this. Maybe I'll make my next lecture all about the bonds, bond markets. Okay. That ends today's class. We do not formally have class next week. I'm going to make a lecture. I'll pre-record it and post it. I won't make it the bond window just because I think it's actually nice to have it where we can all talk with each other, whether you want to or not. Next week's lecture, I'll make it about what the economy is doing for the rest of this year and early next year. So a little bit of economic outlook. And then the week after that, we can do bonds after that. Until that time, though, I strongly encourage you to finish up those first 4 modules in Bloomberg. If by next week you haven't even started the first one and completed it, I'm going to start to reach out to you and say, why haven't you done it? Okay. I will log off last just as usual. So, but I will stop the recording here, but I will log off last. So,